Let's talk about accounting. Before we talk about what accounting is today, let's talk about how it started. Luca Paciolo is known as the grandfather of accounting. He was also a mathematician, among other things, and he taught Leonardo da Vinci. In Venice in the late 1800s, he changed the way merchants did business. Before he published his instructions of accounting, the merchants just wrote down what they did in their business like in a sort of a diary. He put his instructions in this huge comprehensive book of math. Pacioli told them, don't just write down what you do, keep your books. Every transaction impacts your business in at least two ways. In this way, what we still know today as double entry of accounting was born. He told the merchants, you have to keep up with your inventory. You have to keep up with your bank accounts. He shows them exactly how to count all that they had as a starting point and told them this is your capital. These principles are what are still used today. The goal of the accounting framework is to give everyone a common language and a way of thinking about financial reporting. If you've never studied accounting, you may not realize that many estimates and rules have to be applied to determine the amounts on financial statements. For example, how much depreciation should be recorded on the $1 million piece of equipment we purchased last year? Also, should we put a contingent lawsuit on our books as a liability? We may end up paying $3 million. Is that a liability? All these questions and more are governed by accounting rules. People think of accounting as math, but it's actually just an information system. It organizes data and communicates it to users. Users are the interested parties of the business. Let's look at this slide. An example of data is we purchased a new x-ray machine. How do we measure that? Is it the fair market value or the price we actually paid? Accounting rules tell us we must record it at the price we actually paid. We call that historical cost. This keeps the information verifiable. Next, we process it. This just means we classify it. As Luca Pacioli taught us in the 1800s, we record it in at least two places. In this case, cash decreased for the amount we paid, and the other place that we record it is equipment increases for the amount we have in new equipment. Also, as part of the processing step, we summarize it on financial reports. And finally, my favorite part, we communicate it. We provide easy to read financial statements to users so they can make informed business decisions. This activity is a handout that will be completed in groups to give everyone some examples to think about as we go through this class. Step 1 is analyzing. When we analyze in accounting, we first decide if a transaction has taken place. If it has, we determine which accounts are affected. We decide if each account has increased or decreased, and as we later learn, we then decide which accounts will be debited and which will be credited. Finally, we check to be sure our accounting equation, which we'll talk about soon, remains in balance. So for example, if we purchase that $1 million equipment, then yes, we've done something that has changed our business financial position, so that is a transaction. So we will ask ourselves what accounts are affected. Well, if we paid cash for it, an account name is cash, so cash decreases. Another account is named equipment, and equipment will increase. And then soon we'll learn how to debit and credit that and see what that does to our accounting equation. Here's another example. Let's analyze it. We purchased an inventory for $50,000 cash and later sold it for $65,000 cash. Yes, this is a transaction, so next we'll look and see how to record this. Let's get started. We're going to call this part where we put it into those accounts classifying. It's a journal, and you don't know debits and credits yet, but let me just walk you through what this journal is doing. I am recording the transaction we just talked about. I am making my inventory go up. We'll talk about why it's a debit to go up. I am making my cash go down. We'll talk about why a credit made that cash go down. So I got inventory, I paid out cash. Later on I sold it. So I make my cash go up, I make my sales go up. Then I make the expense go up for the amount that I originally paid for it, and my inventory go down for the amount that I originally paid for it. So that's a lot to think about, but all I want you to take away from this at this point is that this is a journal and I have recorded my transactions into my journal. We're going to summarize those. And one way to summarize it is to look and see what our accounts are doing inside of our accounting equation. So let's talk about the accounting equation and how to summarize inside of it. We're going to go over the accounting equation in the next few slides, but I want to introduce it here. We've got our assets equal liabilities plus owner's equity. It makes a lot of sense if you look at it like this. Assets minus your liabilities are left with your equity. If you think about owning a house, your house minus what you owe on your house gives you your equity. It can be said the same thing for a business. But in this way, we're going to look at the accounting equation as assets is equal to liabilities plus owner's equity. So under our assets, we have everything that we own that will provide economic benefit in the future. In this example, cash, accounts receivable, that's what our customers owe us, and our inventory. Then we have what we owe, our liabilities. For us, it's accounts payable. And then all of our elements of equity. Our capital, this is generally the money that the owner put into the business. Drawing is the money that the owner took out of the business. Sales is our revenue. Cost of goods sold is the amount that we paid for the inventory that we sold, and then other expenses. So this summarizes what's in our cash. Every transaction comes down to the amount in our ending cash. This summarizes what happened to inventory. We started with some, but we sold it all. This shows what our capital account is, tells what our total sales are, and so on and so forth. So this is one way of looking at the summarizing of our transactions. We communicate to outside users, we want to make it easier for them to read. So we would not show them that accounting equation. Instead, we would take those results and put them onto a report called financial statements. All heard of financial statements, but we're going to talk about each one and what goes on them. An income statement is going to have revenues minus expenses. And so a common mistake that students make is they think cash should go there. They think, well, cash is a good thing, let's put it on the income statement. Income statement only shows net income. Net income only has revenue minus expenses. So our sales account is our revenue, then we take out our expenses to get to net income of $11,000. Now that's not enough of our story. Another part of our story is, okay, what do we have? What is the financial position of our business? That's the balance sheet. How much assets, how many assets do we have? How much liabilities do we have? How much capital do we have? And it looks just like the accounting equation. So it's got assets equals liabilities plus capital. That's your balance sheet. At this point, we're going to take a break from hearing a straight lecture, and we're actually going to do this because accounting is a doing subject. So we're actually going to analyze these transactions, put them into the accounting equation, and get a summary of results and prepare financial statements. So we'll do this in groups. We've prepared our financial statements. A very important part is to interpret them. So besides looking at net income and total assets equals liabilities plus owner's equity and what ending owner's equity is, we need to interpret that data. There's many different ways to do it, but it always goes beyond just looking at 1 year or 1 month worth of data. We need to compare years, we need to compare to other companies, and we also need to look at ratios within those financial statements. This is known as interpreting, and it makes our information more meaningful so that we can make good business decisions. This is an example of a vertical analysis. And so we're looking at an income statement, and we're going to look at everything as a percent of sales. So of course, sales as a percent of sales is 100%. Cost of goods sold for this company is 77% of sales. And that doesn't mean a lot unless we compare it to either last year or to an industry standard or both. So industry standard is 40%. So somehow or another in our industry, they are not paying as much as a percent of sales for what they're selling. So their cost of the goods that they sell is not as much as what ours are. So either we're not marking it up enough or we're paying too much. So we'd want to look into that. Gross profit as a percent of sales is 23%, so it ate into our gross profit. We have other expenses which are also just slightly higher than industry standard for a total net income. So this is an example of vertical analysis and how it can help us make decisions. This is another example of how we can interpret the income statement. In this, we're looking at last month compared to this month to see what the variance is. So this month we made $65,000 in sales, but last month we made $90,000. So that's a $25,000 unfavorable variance that we may want to look into. And we go all the way down looking at those variances. This is known as a horizontal analysis. All right, I've already shown you the accounting equation, but now I want to spend more time talking about it. So accounting is the language of business, and the accounting equation is how we account for a business. So it can be moved all around with general algebra rules, but we can look at it as assets equals liabilities plus equity, which when we look at it like this, it makes a lot of sense because every single asset that we own either came because we borrowed money from it or we already had it from our equity. So it kind of explains how we own our assets. Then we can rearrange that equation as assets minus liabilities equals equity. This also makes a lot of sense because everything that you own minus everything that you owe gives you your residual equity in the company. These are terms that we've used all of our life, but let's make sure that we really know what these terms mean. Assets is more than just what we own. So it is a value, thing of value, that the organization has a right to use. They are financial resources, equipment, and any other resources to the company that will benefit for more than one period or month. Let me give you an example of that. If I buy a car, the car is an asset to me because it's going to benefit me for more than one period, usually more than 1 month. It's going to benefit me for 5, 6, 10, 15 years, right? But if I buy gas, well, technically I do own the gas that I put in that car, but I'm going to use it up quickly. It's not going to last me more than a period. I don't call that gasoline that I put into the car an asset. Instead, I call that an expense because it got used up. So that's how to differentiate what an asset is versus what an expense is. Liabilities are amounts owed to creditors, amounts owed to banks or whoever else I may borrow from. Another word for that is a debt. It usually ends in the word payable, although there are some exceptions. Another type of liability is called unearned. Let's say that somebody gives me money and I owe them a project. I owe them some work. I call that unearned revenue, and that is also a liability. Equity, or owner's equity, are claims on the business's resources or assets. It's basically the net worth of the business. It can be seen as assets minus liabilities because that leaves you with your equity. That is the net worth of the business. This slide shows us how do we build equity in our business. So what affects equity? Well, the items that increase it are, let's start with this one first down here, owner investments. If we put money, personal money into the business, that increases our equity. But also revenues increase it. Whenever we make a sale, it increases our equity. So opposite of that, what decreases our equity? Well, if you withdraw personal money from a business, if you're a sole proprietor, that will decrease your equity because you took it back out. That's called an owner withdrawal. But also each expense that you pay will also decrease your owner's equity. So the four components of owner's equity are revenues and owner investments that increase it, expenses and owner's withdrawals that decrease it. I want to take a deeper look at those financial statements that we looked at before. So income statement, equity, balance sheet, cash flows. If you look at it like that, then you can use this sentence to remember the order that we prepare these. I eat breadcrumbs. So I stands for income statement, eat stands for equity, bread stands for balance sheet, and crumbs stands for cash flows. We have to do it in this order because we need something from each to go to the next statement. On income statement, you get to net income, and you need net income to get to your owner's equity. Then you need your ending equity to go onto your balance sheet. And you need all of that to prepare your statement of cash flows. So we have to do it in that order. So these financial statements are the business documents that will communicate the information needed to make business decisions. The income statement is going to have your company name, the name of the statement, and then the period. So this is month ended November 30th. So this is just for 1 month. If it was for an entire year, it would have said year ended. If it was 12/31, it'd be 12/31. And so you need to look and see what the period is and make sure that when you're comparing because this is just 1 month of information. If it was for a whole year, it would have had 12 months worth of information. And so then it will list your revenues first. And if we have more than one type of revenue, they would all be here, and then they'd be totaled in the right column. So we have subtotals in the left column, totals in the right column. So it's important for students, especially after we introduce you to debits and credits, to realize there are no debits and credits on financial statements. The users are not typically accountants, and so there are no debits and credits. The only reason why we have columns on financial statements is for subtotaling and totaling. Remember the order, I eat breadcrumbs. We're now to equity, statement of owner's equity. It comes next, and the reason that we had to do the income statement first is we needed this number, net income for the month, $5,300. We needed that from the income statement in order to prepare this statement. So the statement of owner's equity just summarizes what happened to equity. We had a new company, so we started with 0. The owner put in $30,000. We made net income, which is revenues minus expenses, so it nets to $5,300. And then we've got a subtotal here. So far we had nothing plus 30 plus 5,300, so we've got a subtotal of 35,300. Then the owner withdrew 5,000, so our ending capital is now 30,300. And that is all the equity statement does. It shows you how you got from what you started with till your ending for that period. Remember, the 4 components of owner's equity was owner investments, that's here, revenues and expenses, that's netted here, and owner withdrawals. Those 4 components can be seen here. This is the balance sheet, which is just a presentation of the accounting equation. Assets equal liabilities plus equity. And then make sure that we're in balance. We add up our total assets, and we see that they do in fact equal total liabilities plus owner's equity. We had to do the statement of owner's equity first because the ending equity is presented right here under owner's equity, so we needed to know what that ending equity number was, and we put it here, and if we're in balance, then we think that we have everything correct. Financial statement is the statement of cash flows. This really completes the whole entire picture of our company. So something that could happen in the accrual basis of accounting, which we'll talk about later, is that we could show a lot of revenues and even some really strong net income, but not have enough cash. How could that be? Well, what if we sold everything on account and our customers aren't paying us? We would be able to see that best on a statement of cash flows. So what we have here is the statement of cash flows, and all it does is summarizes everything that happened to cash, and it summarizes it into 3 categories. The first one is from operating activities. Everything here happened to our cash inflows and cash outflows, because of normal day-to-day operations. We want to see something positive here if we're a successful business. If our daily operations are successful, we want to have some positive operating activities cash. Skip down here and look at cash flows from investing activities. This is everything to do with cash inflows from long-term assets. So if we sold some of our equipment, we'd have an inflow. But if we purchased our equipment, we'd have an outflow. It's just about our long-term assets. And so this number could be negative just because we purchased new equipment. In this case, we purchased some land, so it's negative. So understanding what goes under the investing activities will help you understand if that number is okay. And then finally, financing activities. This is anytime we needed money or spent money not based on operating or investing, it goes under financing. What goes under financing then would be owner investments, long-term liabilities, and if you're a publicly traded company, it would be everything to do with trading your stock or selling your stock. So stocks, dividends, all that sort of thing. So basically, if you needed to borrow long-term money, it would go under financing. If you needed to issue stock or put personal money into your business, it would go under financing. And then paying that stuff back would be the minus to financing. So if you see a huge positive under financing, you might take note because this means that you either borrowed a lot of money or maybe gave away some ownership through issuing stock. So that's what goes under financing activities. All right, so then you add up or net together operating, investing, and financing, and the total change will equal your change in cash. Let's talk about change in accounting. So we see that that's $9,000. If we were to look back at our balance sheet, we would see that our beginning cash to ending cash changed by $9,000. So that's the net change in cash. And now we've accounted for that net change in cash, and we can see how it's made up under operating, investing, and financing. The users of our financial statements. We're going to break them down into two types. External users. So these are people outside the company like investors, creditors or banks, and the IRS and other governmental entities. They're outside the company. They do not work for the company. Then we've got internal users. These are the employees and the managers, the CFO, and they do work for the company, so they're called internal users. We actually have two different types of accounting for this because we need to protect the external users, so we have a lot more rules. So financial accounting is what we perform for external users, and it has to follow rules, otherwise known as generally accepted accounting principles, GAAP. Internal users, they'll use the financial accounting, but they may also ask for other reports that don't have to follow any rules because they just need to know what they need to know to make business decisions. So like financial accounting has to include everything about the entity. But managerial accounting may say, hey, just tell me the sales just for Mississippi. Well, that's just a tiny piece of the company, but that might be what the manager needs to make a decision. So to summarize, financial accounting is for external decision makers. It answers the questions like, should I invest in this business? Is this business profitable? Or for creditors, it might answer the question, should we lend money to this business? Can the business pay us back? But managerial accounting is for internal decision makers. It answers questions such as, how much money should the business budget for production? Should the business expand to a new location? How do actual costs compare to budgeted costs? This is a summary of what goes on to each financial statement. You can refer to this when you need to review. The income statement is revenues less expenses equals net income. The owner's equity is beginning equity, otherwise known as capital, those are interchangeable, plus owner investments plus net income. Note net income came from here. Less owner withdrawals gives you ending equity, otherwise known as capital. The balance sheet, again, is the accounting equation, so it's going to have your assets, and they will equal your liabilities and your equity. The statement of cash flows will have the change in cash from operating, investing, and financing activities, which will all equal your total net change in cash that can be checked on your balance sheet. Remember how we saw that the income statement was for the month ended? So that's an important concept in accounting. It's known as the accounting period because we measure data in periods. For example, we might say Apple's gross sales last year was this. The year before that, the gross sales were this many. And so at some point in time, we have to cut it off. So we might look at the sales just for a month, or just for a quarter, or just for a year, but it has to be placed into an accounting period. So that brings up a lot of points, because what if you get paid all at once for something that you earn over the next few periods? Well, you have to actually divvy up that money that you got all at once into the correct accounting period. But some information is not period related. Those are known as balances. So for example, cash wouldn't make any sense to put it into a period. It's just a balance at a point of time. That's why on the balance sheet you won't see for the period ended. You'll just see a date. Hey, as of this date, this is the amount in cash. Unless we sold a company and we have a short year, then an accounting period is 12 months duration. Some companies end on 12/31, and if they do, we call it a calendar year. But some companies, normal operations, don't end in December, like a school or a hospital sometimes. And so instead, it may end a different month, and that's called a fiscal year. But it's still a 12-month period. We already know that assets are resources owned by a business entity that will provide economic benefit in the future. Some examples of assets, and these are the actual account names used in accounting, is cash, supplies, accounts receivable, and buildings. So these are accounts that we can actually put the transaction to. For a little interaction and practice, we will look at this slide and decide which are not classified as assets. So the ones that are not classified as assets would be accounts payable, because that's a liability. Vehicle expense, because that's used up in less than a period. It won't benefit you for more than a period. Salary expense, used up in the period. They actually worked for you during that period. Hydraulic lift for the truck is going to help you for longer than a period, so that is an asset. That's going to be an asset as well. Liabilities, which are debts owed to outsiders, usually end in the word payable, so they're pretty easy to find. And one extra liability that's not listed here is unearned. Unearned revenues are also liabilities because we owe somebody the work. We'll talk about some important accounting concepts. So one is revenue recognition. This concept tells us when to record revenue. And you may be thinking, okay, I record revenue when I sell it. Yes, that's true, but some things have to take place before you can record revenue. The main one being, you must have performed the service. So let's say that you're a dentist and somebody pays you before you do the work. They pay you up front. If that's the case, you cannot record revenue. But you might say, wait, I need to record the fact that I got some money. Yes, you do, and you will. Your cash went up, so you are going to make cash go up, but you can't call it revenue. You haven't earned it yet. So instead, you call it unearned revenue until you earn it. So that's an example of revenue recognition. What about if I filled a cavity and they haven't paid me yet? Is that revenue? Yes, you did the work. It doesn't matter that you didn't get the cash yet. So in that case, revenue goes up, but you didn't get the cash. But you know what? You got something else that's an asset that's called accounts receivable, which is just your right to the cash later. So if you filled the cavity but haven't gotten paid yet, then your accounts receivable goes up and your revenue goes up. This is known as the revenue recognition principle. Let's practice that. A customer signed a contract for landscaping of a residential yard. So how would we do this? We haven't gotten the money and we haven't done the work, so we would not record that as a transaction. Letter B says customer signed a contract and paid $1,000 for work to begin next month. Well, here we have a transaction because our economic position has changed, and that is we got $1,000. So cash would go up, but we can't call it revenue. So it'll be unearned revenue until we earn that revenue. So cash will go up and a liability called unearned revenue will also go up. C says landscape work is completed and customer is billed $3,500. Well, because we completed the work, revenue goes up. We haven't gotten the money, but we billed them, so accounts receivable goes up. D says landscape work is completed and the customer paid the full $3,500. So we've completed the work, revenue goes up, cash goes up because we got the money. This is known as the accrual method of accounting, which says that we record revenues when earned and we record expenses in the same period as they were incurred. We haven't showed you any expenses yet, but we'll get there. Match those expenses into the period that they helped us to earn the revenue. So that's called the matching concept. So along with the revenue recognition, we have the matching concept. And so this is going to record the revenue and the associated expense in the same period. For example, if we purchase a car to sell, then we're going to put that car into inventory. Okay, yeah, I just bought an expensive car, but that's not an expense yet because it's still an asset. I will expense it when I sell it. Why? Because I'm going to expense it in the same period that I earned the revenue. I'm not going to expense it when I bought the inventory. I'm going to expense it in the period that I sold the car because that's when I generated revenue. That's called the matching concept. Another important concept is the concept of going concern. This just means that accountants should make business decisions based on the assumption that the business will continue operating for the foreseeable future. In other words, you can't let your inventory go down to zero. You can't be reckless with your cash. You've got to act as if you are going to be operating for the foreseeable future. The entity concept tells us that we're going to separate our business from our personal. Let's say you own a business. You will only put business transactions in your business. So if you pay something for your personal, you will not intermingle those. So business transactions stay separate from personal. That's why you take out an owner withdrawal and then you pay for that expense out of your personal account. You don't mix business and personal because of the entity concept. This is just a little example of how a test sometimes asks this question. If an owner pays a personal expense, it is not recorded by the business. Therefore, the business entity would best be described as the owner is part of the business entity. No. An entity is organized according to state or federal statutes. That's not really describing the business entity. An entity is organized according to the rules set by FASB. Not really describing the entity concept. The entity is an individual economic unit for which data are recorded, analyzed, and reported. Yes, that describes the business entity, so letter D. Here we gave the example of buying $1 million piece of equipment for our business. And we said that we're going to record that using the cost concept. So there are lots of different costs associated or prices associated with a business decision, but we're going to use the agreed upon price, not the appraisal value, not the tax assessment value, not the depreciated value, not because somebody offered us some more money for it, so the fair market value must be higher. No, we're going to record it at the agreed upon price, in other words, the cost that we paid. This is known as the cost concept or the historical cost concept. An example of how we would test this cost concept. On May 20th, White Repair Service extended an offer of $108,000 for land that had been priced to sell at $140,000. And then on May 30th, White Repair accepted the seller's counter offer of $115,000. So we did some negotiation and we came down to $115,000. On June 20th, the land was assessed at a value of $95,000 for property tax purposes. On July 4th, someone else offered us $150,000 for the land. At what value should the land be recorded? Well, we'd look back and see what did we actually pay for it. We agreed on the counteroffer of $115,000, so we would report it there. And that's how it would stay on our balance sheet until something else economic happened that could be verified. So we wouldn't go by the fair market value. We wouldn't go by the appraisal value. It would just be the actual cost that we paid when we purchased that land.